To revive the euro area economy recapitalization, not only in the banking sector, but also we need to understand that there's a repairing of the private sector balance sheets. It's definitely needed. The banking sector is undergoing a necessary process of structural reforms. With concluding the comprehensive assessment, there is a potential to ensure that the credit supply constraints diminish and the cycle finally turns. For a stronger rebound in investment, the private non-financial sector needs to raise equity. This is understood. One instrument especially for smaller and medium-sized enterprises, is to allow the European Union investment funds to be distributed in the form of equity and not only in the form of debt, as the European Bank for Reconstruction and Development, known as the EBRD, and the International Finance Corporation, the IFC, already do in many countries. Now, also, the fragmentation in venture capital markets should be reduced. Why? For smaller firms with the need of deleveraging debt for equity swaps, possibly fostered by tax incentives, could facilitate private debt workouts. So the question is, what is also needed in race to productivity? Well, an upward shock to total factor productivity is needed but only possible in highly competitive markets. This we understand, but across Europe credit growth is weak. In most Central and Eastern European countries, what we consider credit is either stagnant or growing at a very low rate. In many countries of the euro area, credit to the private sector is even in negative territory. The reasons for this are several, but at the heart is a vicious circle of low growth, low investment, and low credit. And the challenge facing policymakers today is how we are going to break it. Furthermore, the current policy debate is largely focused on the credit dimension, and indeed, there is evidence that creditless recoveries, while not as rare as sometimes contemplated, are much less common in high-income financially developed countries or economies than they are in low-income countries. As it has been put, as European economies heavily depend on bank loans, it stands to reason that the recent weak credit performance of Europe is contributing to low economic growth rates. It is nevertheless important that reinvigorating credit growth is not seen as an end in itself. Research based on international evidence suggests that a fast-growing banking sector can be detrimental to aggregate what we consider productivity growth. And we have seen in the euro area that credit growth that leads to the wrong type of investment creates financial imbalances, eventually leading to crisis, while doing a little to support long-term economic performance. Indeed, from 1999 to 2007 period, we saw a positive correlation between the initial level of the GDP per capita and average total factor productivity, or TFP growth. Then the highest TFP growth rates were found in Germany, Austria, Netherlands, and Finland, while in the catching up economies, Spain, Greece, Portugal, and Ireland, the TFP actually declined. An important explanation for this is that the capital in later economies flowed disproportionately and into non-tradable services sector, which in general has lower productivity growth. Investment was highest in the construction and real estate sectors, closely followed by retail, transport, and leisure. This experience shows us that the quality of credit matters as much as the quantity, and it implies that policymakers should also focus on a broader question than just reviving credit, namely. So how can we channel savings towards productive investment? Well, this focus on investment is warranted because in the short run, it is key to boosting demand and creating a self-sustaining recovery. And over the longer run, ensuring that investments are efficiently allocated to help create a virtuous circle between productivity and credit, thus avoiding mistakes of the past. Achieving this requires a policy agenda that encompasses both credit supply and demand factors. It requires that we unclog and diversify the channels of financial intermediation in the euro area, and that we recapitalize the economy through both reducing debt and raising equity, and that we have a policy mix that makes borrowing to invest worthwhile. In other words, it requires a comprehensive approach, and what I would like to do today is tell you and sketch out for you what such a comprehensive approach could look like, drawing on the lessons learned from the crisis and the post-crisis adjustment. All you have to do is contact me. Thank you.